This conference will now be recorded.
Well, everyone, we welcome you here to our February Lunch and Learn. This is one of the more popular classes we offer each year. Steve always does an excellent job with this, and we appreciate very much him being a part of this. Just a couple things to keep you aware of that's coming up with the association. We are in the middle of a legislative session. Fortunately, it seems like their attention is to other matters, from school sports and who qualifies for what, and criminal reform, and all those type of things that's been in the headlines. We've tracked one bill that's specific to licensing. We feel like that has been tabled, and we're still watching it just in case, but it would allow anybody from out of state that has 3 years or more experience to come in and be licensed in any occupation. So fortunately, we felt that this was not something we wanted. It would not ensure that people were properly trained and qualified. So we were able to put that hopefully on the table. We have a couple of smaller ones we're following, and nothing that would really be a huge effect. There is one bill that it seems like the HBA is behind, that they would like to take the cities out of the inspection and plan review process, or at least allow engineering firms to take that role as well. We're just kind of watching that. The League of Cities and Towns have been negotiating with the HBA on that. Frankly, I'm not real excited about it, because I think we would have building permits, plumbing permits, and so forth being handed out when they should be more controlled. But we're just kind of watching that one. There's a lien law, of course. Every session has a lien law change that we're following. But other than that, it's fairly quiet at this point. They're about halfway through the session. Well, wanted you to be aware that we're going ahead with our conference this year. As you recall, we had to cancel it last year. We have that scheduled at Thanksgiving point, something new to bring the conference up here along the Wasatch Front as a change. This is going to be on April 22nd and 23rd. We're excited to be offering that this year. We have a great venue. It's a show barn down there, great facility, large facility. We'll be able to meet the requirements of social distancing and so forth, keep people safe and healthy. And hopefully by then we'll have a lot of people vaccinated at that point. So we also have a trap shoot scheduled for the 26th of May at Lee K. And that's always been a fun event. Once again, we had to cancel it last year, but we're moving ahead with it this year. And then our annual golf tournament on the 4th of August up at Bountiful Ridge. So we're out, we're doing things safely, and we're excited to have a new year. I'm sure you all are feeling the same thing, that we're anxious to get out of the gate and start running. So I think that kind of gets you up to date with the association. We're doing well as a group. We have new members. We have a couple of new members who are joining us on this call, and we're excited to have them a part of it. So with that all being said, as we go through this is being recorded. We will have this up on our YouTube channel in the next day or so you can refer back to it. Steve will have some items, a copy of the PowerPoint that he'll send to me, and I'll make sure to send to each of you and have that available for those who watch it. We also encourage in any of these classes, and especially this one, to ask questions. And there is a way to raise your hand on this. I'll be watching that carefully. It's at the top of your screen. There is little outlines of people, and you can just go to your name and right mouse click on that, and you can send a message to me, a question, or that you have a question, and I will make sure that Steve addresses that. Also, to make sure that you have a good presentation, if you go to your screen and just onto the right, there's a pop-up that allows you a plus and minus, allows you to enlarge the PowerPoint presentation so you can see it better. And then at the bottom of the screen, you can see that there's a button for a mic and camera. If you'll just make sure that you're muted unless you have a question, and then just go ahead and ask the question to Steve. So hopefully we'll have some information that will be worthwhile. Things are changing so much, so quickly. So I think this will be an excellent topic. So Steve, I turn the time to you, and just go forward.
Go forward. All right. Thanks, Dave. It's always a pleasure to do this presentation. This year, I mean, I typically do this in the fall, but this year we were unable to get together and get that done. So doing it a little bit after the end of the year. So a number of things it might be too late to do to save the taxes in 2020, but you know, these are many of the things I'll be talking to you about today will be things I've brought up before, and they're just basic tax savings ideas for contractors. A little bit about me. My name's Steve Scoggan. I'm with a firm called CLA, which stands for Clifton Larson Allen. I used to be a part of a local CPA firm called the Leverage Group. We've always concentrated on construction contractors. You know, probably half of our clients here locally are contractors. CLA is a big CPA firm. We're about the 8th largest CPA firm in the country. We've got 140 offices, of which Salt Lake City is one of them. CLA is also known for its construction expertise, and we're actually the largest CPA firm in the country in terms of number of contractors that we help. So I was talking to Dave a little bit about you know, our history. I've known him for quite a while, and back when I was a member of the Leverage Group, and I was telling him how it's just getting harder and harder for smaller firms to survive and to be experts at really anything. I mean, I remember back in the day, you know, something would come up, a technical issue, a client would have a question or a need, and I would have to figure it out myself, or someone in my office would have to help me figure it out. Whereas when you're part of a large firm like I am now, we have people that we can reach out to that do this kind of thing every day. One of the things Dave and I was talking about is doing a succession planning presentation, possibly for the upcoming April event for the association. And you know, I could do something, and I'd probably do a pretty good job at it, but we've got people in our firm that do succession planning for contractors every day. And so they have a lot of materials, a lot of knowledge and experience that I don't have. I have some, but they do this every day. So it just gives us the capability to really help our clients with a lot of specific complex things, which there seems to be more and more, and we'll talk a little bit about some of those today. But it's just challenging. And you know, you guys want to run your businesses and not worry too much about the details of taxes. You know, yeah, we're going to go over a number of things that are definitely contractor oriented. Again, during the presentation, you know, please interrupt at any time with questions. Either raise your hand or unmute yourself and ask questions. Also, if you want to email me, my contact information will be at the end. And again, I'll send Dave a copy of this PowerPoint, which has my information on it. If you have any questions, you know, please go ahead and send an email to me, and I'll get back to you as soon as I can with an answer. So, all right, let's get started. Okay, some of the things we're going to talk about today. We'll talk about the basic contractor tax savings ideas, and most of you already know about many of these, but we'll focus on some of those. Obviously, equipment depreciation and accelerating that. Contractors buy a lot of stuff, and the IRS code allows big deductions for that kind of thing. Pension and profit sharing plans. Hopefully most of you have something, maybe a self-employed pension or a 401k or something, a profit sharing plan, hopefully. But there are many opportunities for contractors to save a lot of taxes and diversify from their construction company, get some money out of their company and into their own personal retirement accounts and save taxes while you're doing that. So we'll talk a little bit about that. Also, we'll talk about the qualified business income deduction. This came to fruition in 2018, was the first year, but want to make sure you guys are taking advantage of that and understand some of the basics of it, because there are ways to massage your numbers so that you can maximize that deduction. Meals and entertainment, we'll talk about that. There's been some recent changes in that area. We'll also talk about tax accounting method changes. Again, the new law in 2020 or 2018 allowed contractors of a larger size to be able to change their tax accounting method. And, you know, probably most of you are on the cash basis, hopefully, because that usually works out best for contractors. But if you're not, you can change if you're under $25 million in revenue. But then also there are other methods that, and we've been doing a lot of this lately in the last couple of years since that tax law changed, working with our clients to change their tax method and save them some taxes or defer taxes into the future. So we'll talk a little bit about that too. We'll talk about gift and estate taxes and kind of some of the upcoming potential changes in those laws. And then we'll also talk about the new administration and some of the things that they're thinking about doing. We'll see how effective they are in terms of doing these changes. It likely is not going to be immediately, but I would think in the next few years, some things are going to change and some taxes are going to go up. And then we'll talk finally about the new employee, well, not new, employee retention tax credit has been renewed again, along with the PPP, which hopefully most of you obtained PPP loans in the first round. There's another round of that currently in process. So we'll talk a little bit about some of those things. And then lastly, the work opportunity tax credit, something I've mentioned in the past before, but just something to think about if you're hiring a lot of people. And, you know, we're all looking for people, and it's been rather challenging, but there are some tax credit opportunities that we'll talk about. So, all right. Well, equipment depreciation, everybody pretty much knows about this. Bonus depreciation, you're able to write off 100% of any equipment that you purchase the year that you buy it. Bonus depreciation allows us for either new or used equipment. You know, we sit down with our clients at the end of the year typically and say, hey, you know, is there any equipment that you're going to need in the next few months in the first quarter? It might make sense for you to buy it now and get the deduction because it will save you taxes, you know, in April, and it can be a significant savings. Bonus depreciation is great. You can also finance the equipment. You don't have to pay cash for it. You could get a loan. You could buy a new loader on the 29th of December and borrow 100% of that money and save yourself, again, whatever your tax rate is. Take a full deduction for the purchase of that equipment. Say it's $100,000. You know, you're going to save yourself $30,000 in taxes in April. So that piece of equipment doesn't cost you 100, it costs you 70. So if you buy it before the end of the year and put it in service. So again, a real important thing. Hopefully you're all analyzing and looking at your equipment near the end of the year and going, gosh, what am I going to need next year? What do I want to replace? What do I want to improve? It's just a real good opportunity to do that and save some taxes right away. Section 179 is very similar to bonus. It's a little bit different rules. It does need to be new equipment. And again, we typically, when we prepare tax returns, we figure out what the best deduction, how to obtain the best deduction. And sometimes it's Section 179, sometimes it's bonus, but you have an option as to which one to take. But basically the same thing. You get a full 100% deduction for equipment that you buy that year. Real estate depreciation. We all know real estate is a good investment, but it's not always a great tax deduction. You know, depreciation life for a piece of commercial property is 39 years, long time. Residential, 27.5 years. So it takes a long time for you to recapture and obtain tax benefits from real estate in general. One thing I always like to remind clients about is a cost segregation study. And if you don't know what that is, basically it means we offer it here at our firm. Other vendors offer this service, but basically you take the plans and typically come out and inspect the property, and an engineer puts together a program that supports the deduction. But basically what it does is it takes this 39-year property and converts it to 5-year or 7-year or 15-year property. So therefore you can depreciate that building faster, okay? And this, obviously, you can do this with a brand new building or a building you're building or a building you just bought. But if you bought a building 5 or 10 years ago, you can catch up the depreciation you would have gotten over those years. So it can be a significant tax deduction. And again, people don't generally think about real estate as a good tax benefit, but in this case, a cost segregation study can really make it worthwhile. Typically the building has to be $600 to $1 million minimum for it to make sense. Obviously, if it's more than that, the benefits are greater, but it can really help trim your tax bill. Pension and profit sharing plans, another one of the big deductions that if you're in business for yourself and a contractor, if you don't have some sort of a pension or profit sharing plan, you're really missing an opportunity to save taxes as well as set money aside for yourself. Again, very simple self-employed pension set plan is very easy. 401ks are pretty straightforward. Profit sharing get a little bit more complicated, but the benefits are much greater. I think the limits for a 401k are approximately $22,000 a year for each person, including the owner, in terms of to set aside in your pension plan. But so not a great tax savings at $20,000, but a profit sharing plan can be as high as $55,000 can be set aside. And then the big bells and whistles with the defined benefit plan can put aside as much as $200,000 to $220,000 for the owners. Tax deductible currently. Obviously, you have to pay taxes when you start taking that money out upon your retirement. But it's something that, you know, I know we can run numbers and look at your employee mix, and it depends on the ages and how long they've been working for you, et cetera. But it can be just a huge benefit and get as much money as possible, the objective, to the owners, while giving your employees a decent retirement program as well. So, but you know, the one defined benefit plan that I can think of, we have two owners, husband and wife, and they're able to put aside $200,000 each in this defined benefit plan, and then it costs them approximately another $120,000 to $150,000 for their other employees. So we're talking $550,000 tax deduction, with 400 of that going to the owners. So it is pretty significant for setting money aside for your future. Qualified business income deduction. I've been talking about this the last couple of years. This came into being with Trump's tax cut in 2017, which kicked in 2018. And basically what this is a 20% deduction. If you have a flow-through entity, which I assume the majority of you have either an LLC or an S corporation. So if you have flow-through income from your company, flow-through taxable income, you can get a straight 20% deduction. So for example, say you have $200,000 that flows through to you from your business on your K1, you're entitled to, or there's a potential for, a $40,000 deduction for you. And that is shown on your 1040. So something for you to check, maybe jot this down, or when you get the PowerPoint, take a look at your 2019 1040. And on page 1, line 10, you should have a number in that box. And that's basically where the qualified business income deduction is ends up on your tax return. But again, it's a straight 20% of your flow-through income. So again, on a $200,000 income, you would have a $40,000 potential deduction. But there are some limitations, and those limitations have to do with the W-2 wages you pay in your company, or the adjusted basis of any property that you hold in your S Corp or LLC. So in that example, $200,000 worth of income, $40,000 potential deduction. In that case, you would need to have at least $80,000 in W-2 wages that your company paid, giving you, obviously, 50% of that is the limitation that would allow you to take the full $40,000. Now, if say you have a real estate company that holds your real estate and rents it, you know, to your operating company, typically those types of entities don't have any W-2 in them. Okay, so the IRS gives us a chance to utilize some of that. So again, say this flow-through entity holding your real estate makes $200,000. The potential deduction is 40. We can look at it another way. It can be either 25% of the W-2, and in this case, there's zero W-2, so that's not going to help us, but 2% of the unadjusted basis of the property. Well, that means the cost basis of that real estate that you have in your LLC. So say it's $1 million property, 2.5% of that is $25,000. So in that particular case, instead of being able to take the $40,000 deduction, you would be able to take the $25,000, which is the limitation. So obviously, if the building was more, $2 million, that would give you 2.5% is $50,000. That would give you a $50,000 limit. Well, you have $40,000 potential deduction, so you'd be able to take the $40,000. So there's some limitations. we frequently work with clients, namely ones that have LLCs, because in an LLC, technically, the owner is not supposed to receive W-2 wages from that entity. So in that case, they typically get guaranteed payments. But what we can do is either convert them to an S corp and pay the owner's guaranteed payments in the form of wages, or there's other maneuvers that can be done to be able to take that full deduction. And it is a big difference. You're talking about reducing your taxes by 20% straight across the board. So it's really something to really look at, or have your CPA look at it and see if there's a way to more fully take advantage of that deduction. Okay, yes, and if you make less than $315,000 or more as a married couple, flow-through income from your company, then you don't have to deal with any of those limitations. If your income is higher than that, then you'd have to deal with those limitations I mentioned. Meals and entertainment. Well, recently, Congress and the President have increased the ability to deduct meals. Starting in 2021, it's now 100% of restaurant food and beverage is now fully deductible, whereas obviously in the past it used to be 50% deductible, and so it is 50% for 2020, but in 2021, I guess in order to help support a lot of struggling restaurants, it's now 100% deductible going forward. And then as a reminder, remember that entertainment, straight entertainment, i.e. jazz games, greens fees, those types of entertainment expenses that you take your customers out or your employees out, that is 0% deductible going forward. So that didn't change. Tax accounting method changes. This can be really big. Like I said, we've been doing a lot of this over the last couple of years, and it really gives contractors, it used to be, before 2018, it used to be that if you have under $10 million in revenue, you're able to be on a different method for tax purposes, namely the cash basis or completed contract basis, which is another typical contractor method. But if you were over 10 million, you could not, you had to switch back to accrual, okay, which wasn't always beneficial. However, in 2018, they changed the law that allowed, now the limitation was 25 million. So any contractor between 10 and 25 million is now able to be on the cash or the completed contract or other type of contractor accounting methods. And this was really huge for our clients because many of our clients were in that range, over 10 million and under 25. So it gave us the chance to help them change their accounting method. And typically we saved clients many times millions of dollars now in the current year that we changed their method. Now, this is not a tax that goes away forever. It is just a deferral, but it pushes taxes down the road. And, I've always believed that it's better to pay taxes later than to pay them now. We will talk about now some other factors, namely that tax rates possibly might be going up over the next few years. That's another consideration. But bottom line, it's still better if you're going to be in business and continue here in Utah, and most contractors are doing really well, and there doesn't seem to be too much concern on the horizon in terms of a downturn, maybe a slowdown, but if you're a contractor in Utah, you're going to continue to do well for a number of years. So if that's your situation, then it really might make sense for you to look at changing to the cash basis, which is basically where you just pay taxes based on the cash that you receive, and you get deductions based on the checks that you write and the bills that you pay, or the completed contract method, which can even be more beneficial in terms of if you have jobs that spill over from one year to the other and are not complete yet. Basically, you don't pay taxes on income for jobs that are open at the end of the year. And typically, this can be a pretty big number to defer again into the future. There's also other hybrid methods that there's a cash completed contract method, which is another one we've utilized. Again, we try and maximize for that particular contractor and the type of business that they have, what's going to work best for them. And we make sure we inform them that, you know, again, this is not a permanent tax savings. You know, if we're able to defer $1 million in taxable income, we're saving them $200,000 to $300,000 to $400,000 that year in taxes, but those taxes will come due someday. But hopefully that's many years in the future. So again, something to consider, and I'd be glad to talk to you about it further offline if you have any questions. Gift and estate taxes. Well, this is just something to pay attention to. If you're not worth more than $11.6 million, then maybe not so important. But bottom line is the exemption, the lifetime exemption for estate taxes is $11.6 million per person right now. It's scheduled to drop back down, I believe, to $5 million in a few years, but President Biden has been talking about lowering it down to approximately $3 million. So what that means is, and we've worked with a number of our clients that were in this situation, is we want to get assets out of their estate and use up as much of that $11.6 million lifetime exemption, use it up now, so that if the law changes and when the law changes in a few years and reduces that, we've gotten assets out of their estate, namely their business or parts of their business. So this has been a huge opportunity for those that are worth a lot of money, that it makes sense to really consider some estate planning now before the tax law changes. Some possible new administration tax law changes. Well, if you make $400,000 or more, that QBI, that qualified business income deduction that I mentioned, could be repealed. Again, it's going to be challenging, I think, for the new administration. I don't think they're going to concentrate on tax increases and major tax law changes for a while. They've obviously got a lot on their plate, and with the virus and getting that under control, you know, some of these other stimulus packages to get the economy going again or continuing to move along, they're not going to start raising taxes right away. So hopefully there won't be any changes in 2021, but going forward, 22, 23, there's likely going to be some changes. And these are some of the things that Biden has proposed. And one of them is repealing the QBI. The other would be to raise the top tax rate, which was lowered a couple of years ago to 37% is the top tax rate, raising that to 39.6 again, which is where it was. There could be some limitations and reductions in itemized deductions. And also he has talked about, you know, right now the Social Security limit for wages, and self-employment income is $137,000. So it's 6.8% approximately. And boy, it's really 12.5% is the Social Security rate, and that goes up until 137. Then all earnings above that, you don't have any Social Security. Well, he's talking about increasing that at 400,000 and kicking the Social Security back in at earnings over $400,000. So that could be a significant planning thing. Again, none of this has happened yet. These are things he's proposing. Also, a major increase in the child tax credit to $3,000, lowering the estate tax exemption, which I mentioned, and also increasing the C Corp tax rate from 21 to 28%. Also, if you make more than $1 million a year, possibly you could make the capital gains and dividends rate be equal to the top tax rate of 39.6. So instead of 20% capital gains, the taxes could basically double. And that obviously would be a very contentious and controversial change. So we're not sure what the probability of that is, but it's definitely on the table for future discussion. So keep that in mind. Anybody have any questions so far? Dave, anybody type in anything? Okay.
No, not at this point.
Okay. Well, next, let's talk about our wage and benefit survey, which we've done every year for approximately the last 25 years, except for in 2020. We weren't able to pull that off due to virus and other situations. So we skipped 2020, but we are bringing that back to life in 2021. And basically, this is a copy of our 2019 survey, but basically we had, I think in 2019, we surveyed approximately 250 Utah contractors of various sizes and disciplines and asked them a number of questions, everything about how much they pay different positions, but also, what type of benefits they give, how they've been faring, has their revenue gone up recently? How many people do you plan to hire in the next year? Some really good information. And we publish this survey report this year. It's going to be approximately, you should be starting to get questionnaires here in the next month or two. And then we'll publish the survey in the summer. And then typically Dave gets a copy of that and we can send that out to the members. But we would encourage you, please encourage you to definitely fill out the survey. It takes maybe a half an hour, maybe less to fill it out. It's all done online and you should be getting that sometime in the next couple months. But basically it shows wages, average wages, and median wages for approximately 30 different positions. Everything from concrete workers to landscapers to mechanics to estimators to drywall, concrete, flaggers, glazers, plumbers, office and accounting positions. It's really, really helpful. And if you want, you can shoot me an email and I can send you the 2019 version. I know a lot of you already have this, but if you didn't have a chance to get that, I can send you the 2019 version in a PDF so you can kind of get a flavor for some of the questions and some of the information that will be provided on the 2021 version. So hopefully you can participate in that. Okay, we're going to get into a little bit. I'm not going to get into a lot of detail. Hopefully, most of you obtained the Paycheck Protection Program loan. I know the vast majority of the clients I work with did, and some of them it was a perfect timing, because we had a number of clients, and And just over in general, you know, hopefully you're all being able to maintain your success. You know, I would say overall, with the probably 30 or 40 contractors that I work with personally, I mean, on average, they not lost, but were reduced maybe 10 to 15 to 20% in revenue between 2019 and 2020. At least so far. We're working on, you know, year-end financial statements now. So it really wasn't devastating. I mean, we did have a few contractors that did have some issues, but we also had contractors that had the best year they ever had in 2020. So hopefully you're somewhere in the middle there, but most of our contractors did get the PPP loans, and there's a new batch out there now, and basically if you have a 25% reduction in your gross receipts in any calendar quarter, in 2020 calendar quarter compared to the same quarter in 2019, if you have a 25% reduction in revenue in any one quarter, you qualify for the new PPP. They say the deadline is March 31st, 2021. There is a limited amount of money. It's quite a bit of money, $284 billion. I think in the first few weeks, there was about 40 or 50 billion that was used up. So there's still plenty of money sitting out there for everybody to get. I know some banks are not accepting applications yet. It should be any minute. There's a number of them that have been accepting for the last couple of weeks, and actually have some clients that are set to receive their second PPP loan very soon. If you haven't applied, definitely reach out to your banker and talk to them about this new PPP program. But one of the things you would have to have is have your quarterly revenue mapped out, 2019 quarters, compared to 2020 quarters, so that you can prove that you qualify. So make sure you check that out. Employee retention credit. This is probably one of the more complicated government programs that have come out in a while, but I'm going to try and give you just the basics of this. Basically, this was available during the first PPP period this last summer, but the problem was you had to pick either the PPP loan or this employee retention credit. You couldn't do both. And at least in most of the clients that I worked with, it was kind of a no-brainer that the PPP loan was much more beneficial to them than this employee retention credit. Okay, so most people didn't dig into this much because it really didn't matter during that first PPP period. But now this new PPP does allow you to take the employee retention credit also. So an important point, and basically it's if you have 20% reduction in gross receipts with comparing the same quarter of 2020 to 2019. Now this is different than the 25% reduction for the PPP. This is only a 20% reduction. So if any given quarter, 2020 compared to 19, you have a 20% reduction, then you qualify for this employee retention credit. Okay, and the credit is about 70% of the first $10,000 of wages per quarter per employee. So again, this can be a significant number. I'll give you some examples here. Here's also some articles that might help you on the details. Again, it's fairly complex, and you have to look at your particular situation. But number one, you have to have in hand, you know, your quarterly revenues during that period. take a look at those and maybe pull up some of these articles. Again, Dave will send you the PowerPoint so you don't have to jot down these links. But you can also just go to claconnect.com, which is our website, and type in employee retention credit, and there's a number of articles. These articles, as well as some webinars that we've done, a lot of information in there on these programs. So check that out. Or you can just Google the employee retention credit. I think CLA's articles come up in the top few choices there when you Google it. Okay, example, and I'll go through these really quick. This is example number one. We've got a contractor that has one employee, and their 2020 revenue declined by 20%. Their wages for the first quarter of 21 is $9,500. They have health care of $1,000, and it does include, you can use any benefits as part of the calculation, but it's limited to $10,000 per employee. So basically you get a 70% credit of that $10,000 for that first quarter. You would get a $7,000 credit for that particular contractor with one employee. And this is it's claimed on Form 941, your payroll tax returns, and it's refundable. So it's, again, this is money that's sitting on the table, and if you're not aware of it, the IRS is not going to call you up or send you a letter and say, oh, you forgot to apply for this. This is money that's sitting there. So I'm making you aware of it. Please check it out yourself. You can get back to me if you'd like, and we can help with this. Another example, here's scenario number two, a contractor with 40 employees. They received a PPP loan, and they had some government shutdowns or reductions, like I mentioned in the quarterly reductions in revenue, or if they had any job site closures, then they qualify. You look at the wages, and again, they get $10,000 per employee at 70%. So in this particular case, this contractor would be entitled to a $150,000 tax credit on their Form 941 in the first quarter. Again, a significant number. And again, there's a lot of detailed rules behind all this. How do you treat the owners, et cetera, et cetera. But just want to make you aware. Then here's a large contractor with 330 employees. And we actually have a couple of contractors that got well over $1 million of this employee retention credit. So again, it can be really significant. And it's kind of, again, this is a benefit that really is not really known, because again, during the first PPP period, nobody really looked at this because PPP was so much better and you couldn't do both. But now you can do both. And then there's a small Utah, or a decent Utah opportunity, small business quarantine employee grant. So if you had to quarantine employees during the last year due to either someone in their family or them thinking they had coronavirus or they had it, if you had to quarantine them and you kept track of how much you continued to pay them during this period, you can get a grant for that money. You have to have less than 50 employees in this particular situation, but I think there's $3 or $4 million in this pool for Utah. This is just a Utah thing. So maybe Google the small business quarantined employee grant for Utah and check out some of the details. But again, another fairly unknown benefit that again is just sitting there. And lastly, The work opportunity tax credit, I've mentioned this before in prior presentations, but this actually was set to expire at the end of 2020, but then the CARES Act and some of this new legislation brought it back to life. But basically, if you hire people, we're all looking for people, and if you hire some people in these different groups, whether it's long-term unemployed or veterans or ex-felons, food stamp recipients, etc., if you hire these people and within 28 days of hiring them, you fill out this simple form 8850, and if they qualify, you send that to the state of Utah, and Utah basically decides whether or not they qualify or not. If they do, then, and you continue to pay them and employ them for a certain period of time, you can get up to a $9,000 tax credit per employee in this category. And you know, we've got a number of contractors that are taking advantage of this, but the best story is we have a couple of call centers that we do work for. And obviously they have huge turnover and they hire lots and lots of people during the year. One call center, I think, got $450,000 worth of tax credits from this program. And CLA can help with this and make this be part of, you know, your onboarding. When you hire someone, there's a simple website that you can go on and have them fill out this simple form, and CLA will take care of getting it approved through the state and all that. And you don't pay us, you pay us a fraction of what the credit is, but you don't pay us unless you get the credit. So again, another service that we can possibly help you with. But yeah, just again, money that's sitting there on the table, and if you don't know about it, nobody's going to call you. All right, well, there's my contact information, and any questions, you know, funnel them through Dave or send me an email or give me a call. Again, I will make this PowerPoint available to Dave, and he'll send it out to you, which has some of the details. But yeah, it's never a dull moment in my business, probably not yours either, but it seems everything is always changing, and you have to keep up with all these things. And it's definitely my job to let my clients know and let the association know about some of these opportunities, because there's a lot of them, and hopefully they can help you. So again, thank you for your time, and if anybody has any questions.
All right, Steve, thank you very much.
You're welcome.
We appreciate it very much, taking the time.
Yeah.
Great information. And if anybody has any questions, I'd be happy to forward those off to Steve, or you've got his contact information there on the screen. Every year you do a tremendous job, Steve. Thank you. I'm happy you have the mind capacity that you do to deal with all the government and IRS. I tell you.
Yeah, right. Well, and that's another thing. I mean, I don't know if you guys have been dealing with a lot of challenges with the IRS. I mean, we've had clients receive notices that says that the IRS didn't receive a payment that the contractor made 4 months before, and the check cleared 4 months before, and the IRS said they didn't get it. So, I mean, I know I had some clients that last year, when we had, you know, the extended due date of the tax return to July, we had people that extended their return or made big payments in July, and the check was not cashed by the IRS for 3 months. I mean, I had one client that wrote a $400,000 check to the IRS, and the IRS didn't put it in the bank for 4 months. So the IRS, needless to say, is still catching up from you know, when they shut down for, I think, 2 to 3 weeks back in March a year ago. They're still recovering from that. And you know, as we all know, the poor IRS doesn't get any funding, and they're really struggling. But so if you're getting notices from them and they don't make any sense, well, that's kind of par for the course these days.
Well, I appreciate it. CLA is a great support to the association, their sponsors, their members. So if you need any CPA work, please consider CLA and get a hold of Steve. One last thing that I just want you to be aware of, we have these stickers here. I'm putting in front of the camera here. They are for your vehicles and for your office door. We want to make sure that as members that people see that you're qualified. We're going to start using this, we're continuing to expand our brand in this area and encourage you to order those from us here at the UPHCA. Well, thank you very much, everyone. This has been recorded, and we'll get back with you in the next couple of days so that you can view it again if you'd like, or encourage other people to view it. Thanks a lot, everybody.
All right. Thanks, everybody. Bye-bye. Thanks, Dave.
Thanks, Gary.
See you later.
Okay, take care.